All right, let's just jump right in. Real estate investing can feel, well, a little intimidating, right? Like it's some kind of exclusive club with a secret handshake. But honestly, it doesn't have to be. So today, we're going to pull back that curtain and break down the absolute essentials you need to know to even think about getting started. It's the big question, isn't it? You see people building these massive portfolios and you wonder, how does that actually work? It's definitely not just about buying a house and crossing your fingers. There are real strategies, real goals, and getting a handle on them is the very first step to seeing how it's done. So let's start with a big why. Why even get into real estate in the first place? Well, when you boil it all down, it really comes down to three main goals. Let's take a look at each one. First up, and this is the one everybody thinks of, is income. This is as straightforward as it gets. You buy a property, maybe it's an apartment building, maybe it's a small retail center, and you collect rent. The whole point is to create a steady stream of cash flow month after month. It's all about making that property work for you right now. Next, we have appreciation. And the key word here, you got to remember this one, is passive. This is when your property's value just goes up all by itself. You're not doing anything. The neighborhood is getting better, demand in the city is growing, and just like that, your investment is growing over time without you lifting a finger. And finally, there's investment gain. Now, if appreciation is passive, this is the total opposite. This is all about being active. This is where you, the investor, are directly creating more value. Think about buying a piece of empty land and turning it into a neighborhood, or taking an old, run-down apartment building and making it the nicest one on the block. You are physically creating that extra worth. Okay, so we've covered the why. Now for the how. Look, if you want to invest smartly, you absolutely have to understand the numbers. But don't worry, the math here is actually pretty simple. But the insights it gives you are, well, they're incredibly powerful. This is the million-dollar question for any investor, isn't it? You can't just go with your gut feeling. You need a real, concrete way to look at a property's income and figure out what it's actually worth. And that is where a couple of key calculations come into play. It all starts with something called net operating income, or just NOI for short. It's really just a two-step dance. First, you add up all the potential rent you could possibly collect in a year. That's your gross scheduled income. Then you subtract all the costs to keep the lights on. We're talking taxes, insurance, repairs, the whole shebang. Let's put some real numbers to this so it makes sense. Imagine a building could bring in $180,000 in rent for the year, but it costs you $125,000 to operate it. Well, that leaves you with a net operating income of $55,000. And that number is so important because it's the pure profit the property is generating before you even think about your mortgage payment. Okay, so now that we have that NOI number, we can figure out the capitalization rate, or what everyone calls the cap rate. Just think of the cap rate as a way to measure a property's profitability. It gives you a single percentage that tells you the return you can expect, which makes it an amazing tool for comparing one property against another. And the formula itself? Super simple. You just take that net operating income, our $55,000 from the example, and you divide it by whatever the property is selling for. That gives you a percentage, and that's your cap rate. Easy as that. So, using our example, if that property is on the market for $550,000, you just divide the $55,000 of income by that sales price. And boom, you get a cap rate of 10%. Here's a simple way to think about it. For every single dollar that property is worth, it's generating 10 cents in pure profit each year. But of course, no investment is ever just pure upside. Every single opportunity out there has its own set of risks and its own rewards. So let's get real and break down the major trade-offs you have to think about with real estate. So on the reward side, you have two absolute superstars. First is leverage, the ability to use the bank's money to control a huge asset. It's incredible. And then you have some amazing tax advantages. But, and this is a big but, on the risk side, real estate is not liquid. You can't just sell it in 5 minutes. And it needs to be managed, which always takes time, effort, and money. And this point is so important, it's worth saying again. Unlike a stock or a bond you can sell with a click of a button, a property takes time. You got to find a buyer, negotiate, go through closing. Your money is literally locked into that physical asset until you can find a way to sell it or refinance. Now for what many people consider the number one reason to invest in real estate, the tax breaks. And the big tool here is something called depreciation. Basically, the IRS lets you deduct a slice of your property's value each year as a paper expense. This magical deduction can shelter your real rental income, which means you could have cash coming in but pay way less in taxes. So you get the goals, you get the math, you understand the risks. The next logical question is, how do you actually get in the game?
Well, you might be surprised that you don't actually have to go out and buy an entire building all by yourself.
There are really two main paths you can take. You can invest directly. That means you are the one buying and managing the property. Or you can invest indirectly, which means you're buying shares in a company that owns and manages all the real estate for you.
Probably the most popular way to invest indirectly is through something called a real estate investment trust, or a REIT. The easiest way to think about it is like a mutual fund, but for real estate. A REIT pulls money from tons of investors and then uses that giant pile of cash to buy and manage huge properties, like office buildings, shopping malls, you name it.
And this table really breaks down the trade-offs with REITs. On the one hand, the advantages are awesome. You get professional management, diversification, and liquidity. You can sell your shares tomorrow if you want. But on the other hand, you're not in the driver's seat. You give up control, you have to pay management fees, and your success is really in the hands of the fund's managers. It's that classic choice between convenience and control.
So at the end of the day, there are a bunch of different ways to be a real estate investor. You could be that hands-on developer, a landlord chasing that monthly cash flow, or a totally passive shareholder in a giant portfolio of buildings. Each path has its own rulebook and its own set of risks and rewards. The only real question left is, which kind of player are you going to be?